We have reached the top of the hour, and that can only mean that it's time for Brett Manning to enlighten us with what's going on in the markets today. Good morning, Brett.
Good morning, Jim. How you doing?
Doing all right. Looks like the crude oil analyst at least had the right direction this time, right?
Yeah, it's a huge victory.
Hey, you got to start somewhere. So what's your takeaway? We had a big rise up in crude, and now here we are giving back all those gains, and now we're trading underwater. Anything change in your opinion based on the latest data?
Yeah, so I think it's about the best data that you could have had. Significant draws versus expectations across all categories, and no increase in production, with the market that's still near 70 and still seeing some supply issues. So it's about the best data in and of itself that you could have had. And this is the second time in a few weeks that we've seen really good data sold. At this point, it's starting to look like it's getting sold. Now, a lot of times you get a knee jerk and then a reverse knee jerk, and then you kind of work back. I've seen that. Basically, if you think about it, something like floor traders trying to shake people out of a position they want. Mm-hmm. So let's say they want to be long, but they've got some customer orders piled up as ammunition that they can throw at the market to bang it back down, force some stops to run, and then buy that. So we'll know in about half an hour, 45 minutes, if we start working back above 69.20, then this is a market that wants to move back above the 50-day, back above the trend line, back above 70, etc. But if that's not what's happening, if this is getting sold, if we sucked people in on the data and now we're rolling over because of something bigger that the market's looking around a corner at, then it kind of plays into my sense that this is a market bound to test 65, 64, and complete that swing, that round trip off of the rally we saw following OPEC.
Okay, so you're going to wait on that before you even consider putting together any trades, right?
Yeah, I want to see how they handle this sort of reaction to the knee jerk after the knee jerk. And if we just see that, what I'm really looking for here is some of you guys out there probably have heard me use the term a lead blanket offer quite a bit over the years, and it's just a sense that that there's something there. There's just one iceberg after another on the offer side of the market that's just that's just trying to get off a lot of supply, and you get this feeling that it doesn't matter what kind of setups you see on the super short-term chart. You could see bullish setups, bearish setups, anything. It doesn't matter. Everything's going to eventually hit that offer, get soaked up by it, and start to tick back over. And if I get a feeling in the tape that I'm seeing that kind of thing at this point over the next hour or so, then I will probably start to short oil.
Okay, well, throw that one on the radar. We should probably get some ETF equivalents, either UWT or that USO that we might be able to do if you're going to do that. We've never done that yet, have we?
Have we not done what?
We haven't put together the equivalents so that those who don't have futures.
No. So we need to do that.
Yeah, we do. Shame on us. But so after this, we'll work on that. All right. So in terms of your Dow position, pretty choppy waters here today, right?
It's so ugly. Look at this chart right now. I mean, if you just look at like a 3-minute of any one of the indices, it's like somebody threw up on my charts. It's not pretty.
Yeah, it's...
And, back and forth, back and forth, back and forth. Headlines, narrow range, stops getting kicked out on tiny positions. Everything's just all crammed together. Whatever it's going to do, it hasn't done. And so, there's relative weakness. With the way that I looked at today, I came in basically saying if we see a pop in across the indices right out of the gates, first couple minutes, and I see one of them lagging, I'm going to short it. And the idea there is basically I think that it's open season for fading and using relative weakness early in the day, first half of the day at this point. Late half of the day, you don't want to do that because you're going to be running into a different dynamic as people position ahead of, some of these bigger earnings plays that, there's so much this week coming out during that, 18 hours or so between market sessions. And anytime you start to get close to the threshold of entering that process, I think earnings growth is the market's strong point right now. There's a lot of other things that are threatening to work against it, but at the end of the day, earnings growth is the most important factor, and it is clearly the best argument that bulls have. And so anytime you get close to tons of data that's going to reaffirm that, it's going to be really hard to get downside follow through. But for the first couple hours of the day, if you see setups, I think you go for them on the short side, because we're seeing over the last few days, we're seeing those shakeouts and those spills. And in fact, the one that I put on, even though it's an ugly, ugly chart, it had a lot of advantages to it. And if you had stuck with it longer than I did and just kept the original stop in place, you would have at least seen yourself get up on a 2-to-1 ratio to initial risk. So even in this crap, that was still available. And I bet it's still going to go down and test that 25-100 level. Looking a bit like it might drop right here. But, it's ugly action so far today.
What are you waiting on to see things open up then? What's going to be the part in the Red Sea that you get enticed again in the equity markets?
Oh, it's just like last quarter. Once we get past all the FANG stocks,
all right.
I think then you no longer have to worry about that situation that you've got, this index moving big print that's going to hit at 415, that's going to, chase every short in the market out. Once you get the ability to play both sides of the tape throughout the whole session, that's, I think, the best time in general for trading. The best windows, I think, are the last week or two of earnings season and the first week after it. I think that's when you really you've got earnings data. It's now a data point. It's not it's not something you're looking ahead at. It's something that you've got in the near rearview mirror, and the market is displaying its sense of that, and you're not yet starting to price in the next set of earnings prints, a few months down the road. I think that period tends to be the period where you've got the cleanest setups in terms of how they play out.
All right. Now, one of the markets that you focused on in your morning report today was the euro, and we got a consolidating pattern. So walk us through what you're waiting on with this ECB meeting on deck.
So the way that so there's a couple of things. Obviously, I completely agree. First of all, I completely agree with what Gavin posted a few minutes ago as far as the meaning of the headlines that we just saw. So you're coming into a situation where the White House is preparing for a mano-a-mano style negotiation moment with Jean-Claude Juncker and Donald Trump, and that's happening, in the next few hours. Mm-hmm. And right ahead of that, we're going to put out a headline that says, "Yeah, we're really going to put these auto tariffs on against Europe." It's so obvious, it's so transparently a negotiation tactic to try to remind whoever's sitting on the other side of that table that you're serious, your guns are cocked and loaded, and that they're to change their expectations to where what would be great is to concede, because it's so much worse if you don't. Just to kind of put that framework in, and there goes the Dow, by the way. We're testing that 25-100 right now.
Yep.
Should have just put that right back on. I just think it's so obvious that those headlines are not new information. This is all about setting the terms of battle for that process. And at the same time, we're heading right from there into the ECB. And so first of all, to go back to the trade theme, if you look at the renminbi over the last couple of months, there's a playbook here. So when you're going up against a superior size bilateral bully style negotiation partner, the U.S. is kind of creating this, we're a 6-foot-tall fourth grader on the playground, and we're going to go around one-on-one and start to talk about where the lunch money's going. And, there's really no bilateral negotiation that is a simple, even matchup in terms of cost and benefit analysis for anybody, and that's exactly why this White House wants it to be a bunch of bilateral negotiations. So there's a couple of different things that can happen from the other side of the table in that situation. Number one, you can't bluff the same way because, you need the United States more than the United States needs you. But you can do a couple things. One, I think the international coordination idea is a really interesting game theoretic kind of viewpoint, and something that I'm just kind of playing around with. It's probably one of the most interesting ideas out there from a thinking about the world around the next corner theme and trying to think about how to implement something as far as a trading strategy that draws on the idea that we may start to see more confirmed sense that there's international coordination that's coming to the table as big trading blocks to negotiate with the United States. That's one thing, but the other side of that playbook appears to be letting the currency go a little bit. And the renminbi is a perfect example of that. We've seen a huge dive in China's currency over the last few months, and that is in response to the trade war. And it's not necessarily that they are artificially depressing their currency. This is a pegged currency. They can choose where the levels are, but choosing that means you're deciding whether or not to hold it up sometimes, or sometimes you're deciding whether or not to keep it down. It depends on where the pressure is. And right now the pressure probably naturally in that market is to the downside, and they're just choosing not to artificially hold it up. But that means they're canceling out some of the pain of these tariffs because they're reducing the price for foreign consumers of Chinese goods in the United States. So when you go to Walmart and you buy a lawn chair that's made in China and a tariff is slapped on it, you're going to see it with a 20% hike in price. But if their currency dives, then they're sending it over at a lower price. So they're kind of offsetting the tariffs a little bit with how the currency is moving. Now, with all of these threats coming out against Europe and the tariffs that we may place there, there's a possibility that people are going to start to move the euro the same way. And so I think that force is in place, and obviously today's really big. If we come up with some kind of deal, Juncker and Trump sit down, and they talk like men, and, the world changes or whatever, then you're going to see maybe strength in the euro. But if that doesn't happen, and it seems to me the likelihood is that that's not going to happen yet, I don't think that we've reached that stage of desperation from either side, and there's a lot of ego wrapped up in this, and there's a lot of contentious anger from both sides. So I don't think we're quite there yet. So let's say we don't get that. That is an implicit pressure to the downside, I think, in the euro. Now we're coming into Draghi right after that, and my belief, and I talked to Gavin about this a couple of days ago, is that the likelihood is that we will see, and we've already seen some of it, but the likelihood is that we will see some hedging on the idea that they're winding out of QE right now, because you've got the Brexit uncertainty, you've got the uncertainty around the tariff war, and you've just got a lot of, the Italian banking system, all sorts of things that look like risk factors, and they really have a situation where, if you pan back and look at the last 20 years and their short-term rates, it's highly correlated to what we saw in Japan from about 1985 to 2005. And there's a lot of correlated demographics through that period too. And I just don't think that, the European Central Bank is going to be it's going to feel too much pressure about inflation in that kind of context right now. So, I think it's something they could back off of. And I think if you back off of that, here, now we're probably not going to hear that tomorrow morning, but we may hear a little, something that undermines confidence in people who've been buying the euro based on the idea that the ECB is now, 100% moving through a process of normalization. There will be a sustained and directional move. If we start to erode the confidence of that, you could see bids just fall out of the bottom of that. So I continue to have a short bias there. I continue to have a long bias in the dollar until those ideas prove me wrong. And proving me wrong would be I get information just like I just described, and the currency doesn't move. Then I would probably just drop that idea. If we start to hear that the trade war is amping up with Europe, and we start to hear Draghi start to hedge against the possibility of, moving out of QE, moving out of normalizing, generally speaking, or maybe putting things as a little bit more conditional or contingent in terms of the language, and we don't see the euro drop, then that would be something that would probably cause me to question that idea. But right now, I think it's possible that we will see a retest of the lows and a break of the lows, and I'm looking for, from there, I start to look for how I would structure setups and look for a setup. I've tried twice with that on small size and taken a couple of small cuts. So I'm a little bit more tentative about putting it on because, this is not a super high conviction idea yet. If the right type of short time frame setup appears and how I'm looking at the situation starts to be a little more confirmed, then I'd be going after that again, most likely with a target of maybe under 114 and the possibility of even something like 112 or 113.
Okay, so in this instance as well, it sounds like you're going to let the headline event pass and let the dust settle a little bit before you're even thinking about putting on a trade like that. You're not going to jump the gun and do it before the ECB meeting, right?
Essentially, in every instance for me, ever in trading. That's my approach to trading.
Really?
I never try to guess at headlines. No, that's just not. I look at how there's an edge. There's always, well, let me put it a different way. There's a way to frame the concept of edge, and for some people, that's what they frame as their concept of edge. I know I've been doing this enough years to know where my edge is, and my edge is in characterizing a framework of a situation. Understanding where the news context is so where that data is already in, where I understand what the world is like, and now I'm looking for signs about what the market is like in that world. And my edge is in pattern analysis and tape reading after I'm able to deeply understand the context. So that's where I see my edge, so that's usually how I like to trade, is to try to take advantage of something that I feel like I have an advantage in. When I'm playing that type of game, I usually have an advantage.
Okay, and that makes perfect sense. Any other trades that you're looking at? Any other markets that are catching your attention right now?
Let's see. I don't know what the trade would be. I think the Japan situation is pretty interesting, just in terms of what they do with policy and what kind of context that is. If they shift, they've been doing something completely different than every other central bank out there in terms of actually targeting the 10-year rate and pinning it to 0%. And now they are at least, floating some trial balloons out there of shifting that strategy and releasing their grip a little bit. And I'm interested in that in general because that's such what I think of it as such a inherently risky strategy where we haven't seen the part of it that's risky yet. And the part of it that's risky is when they try to start to exit it in any way. Now, I don't think they've got a lot of pressure to be tightening policy, but rates globally have generally been moving up over the last year and a half. And, there is a fungibility and a cross-border flow for sovereign debt. And so with the Japanese 10-year attempting to be pinned at 0%, you have to imagine something like a theoretical version of that rate that has been moving higher. And the further away that theoretical version of that market gets from where they're trying to hold it, the bigger the risk is when they try to take it off. And I don't know where that is, and nobody really knows where it is. And it's just a really interesting situation because I don't know if we've ever really seen, the closest thing to seeing this kind of market situation is, I think they used to do price fixing in the commodities markets in the early to mid 1970s. And, some of those things would be pinned at a certain level, and you would start to see, if you read some of the books about that period in trading, you'd start to see some of the out contracts in futures markets, once they started to have them around commodities, start to move higher than the price fix. And you could get a sense of, you weren't sure how far away it really was, but eventually they had to lift the fix, and you'd see these massive rallies in some of these things. And it all depends on how badly they've misjudged how much pressure they've been putting on the market, and the people in charge of making those decisions don't really have any way to know for sure. And Japan's been doing something a little bit like that. And I wonder about a couple of things. One would be, what is the way that there's so many billions of dollars in the world that are in some way a function of that, and you've got so many different people tied into trying to manage portfolios and strategies that depend in some way on that. And how, it's kind of like thinking about a bubble in the wallpaper, and we push it down here and it's going to pop up somewhere else. So that what they've been doing has been popping up in some way elsewhere. And watching even them talk about trying to take that policy off, trying to understand how that's playing into other things is just, I think, tremendously interesting. And obviously, the yen and its inverse correlation with the Nikkei comes into play, and there's where the tape reading would be if we start to see some headlines around this. I think there could be one way to look at it from just simply saying, what's a trading strategy related to all this? Sure, that's interesting, but where does this possibly impact trading? And one thing would just be to think about the idea that we could see a lot of volatility in anything Japan related that maybe is in excess of where we see it pop up other places, or we could see it pop up in other places as well because it feeds into the dollar, it maybe feeds into U.S. debt. There's a possibility that some of what we've seen in our long end popping up over the last few days has something to do with this, and maybe some hedges just basically shorting U.S. bonds, shorting a couple of other things to try to hedge against this possibility. But that it's the possibility is there that we could see a lot of volatility around that, and so that's going to be next week that we'll get some kind of verdict on that, and it could fizzle into nothing. But it's definitely something to at least be cognizant of if you're a top-down trader.
All right. Before it gets too far away, I want to mention that Scalp Trader got long TLRY. It's trading right around where he got in, 25.10 right now. He's risking 1.5 on this one, and I believe that is a Chinese stock, and that's a perfect segue into another question that I want to ask you about the A shares. You mentioned the other day, I think it was last week, when we had talked about, is this a potential buying opportunity because it's moved it was trading at its lows. I think that might have been Friday when we talked or whatever, and you said that you might consider doing a short in the A shares. So has it reached a point where you'd consider shorting the pop? And I guess TLRY is not a Chinese stock, it's a weed stock. It's a marijuana stock.
Yeah, right. Important to clear that up. So one thing that kind of plays into this is there was a huge fiscal stimulus move by China in the last few days that kind of corrupts that data of looking at the technical reaction. I mean, more than it's also symbolic. I mean, they did do a lot of stimulus, but there's also the symbolic sense that, maybe this is another element of the playbook for how they're going to deal with pressure from the U.S. on trade. Not only are they going to let the currency depreciate, but they're also going to do, we just saw the same thing from the White House yesterday, saying they're going to, make billions of dollars available for aid to soybean farmers. So, this is becoming part of the narrative of the trade war, is that the governments are taking a tough stand against each other and then trying to soften the blow to give them more ammunition to go out and play hardball in the next round of negotiations by providing some kind of aid or stimulus to buffer how what the other side is doing will impact the actual economy. And, that's, I think, what we're seeing Chinese equities react to right now, is the idea that there's this other side of the playbook, that this isn't just we're going to watch all of these companies fold as, their goods are tariffed 20% going to their biggest market. Like the government's going to step up and try to defend its domestic economy and hold this up. But, another way to look at it, maybe this is that short, or we're closing in on the possibility of it, because another way to look at that is this may signal that they're going to continue to play hardball. And, taking this strategy, I think that the Chinese market would fare better if they conceded a little bit. Now, I'm not saying that that would be the best course for China over the long term. I don't think it actually would. I don't think that you can concede in this situation when you're thinking about the next 10, 20, 30 years for China, which I think they think in terms of this sort of thing from a very, very long time frame. And I don't think that you can cultivate increased support in the United States politics for protectionism against China, and think that that's going to really help you out over the long term. So, but I think that right now you probably have the most initial upside over the next couple of months in Chinese stocks if they were to come to the table with some concessions, and the White House were to try to positively, because I imagine if they came to the table with some concessions, the White House would probably want to make a very positive example of them, so that its negotiations with Europe, Japan, Canada, Mexico, everybody else, that this would be the carrot. They want the carrot and the stick, and the carrot would be if you give in to something that we want, we're going to reward you. There's going to be a huge celebration by the White House of how awesome China is, and probably maybe some kind of minor concession back the other direction, and just to kind of try to show that that's reward that behavior in some way to make an example, so that they start to get concessions from everybody else. So I think that probably would be how you'd see the biggest rally in China, but I don't think China's going to do that. And one way to see that maybe that's not what they're going to do is by seeing this sort of strategy, by stepping up to the plate and saying we're going to try to protect our domestic economy, not with concessions to the United States, but with internal stimulus. So maybe this is something where we wait for the Shanghai to hit that 50-day. It's under it a little bit right now. Pops up into the 50-day. Maybe we do start to look to favor that in ASHR, which is the ETF I would use.
Okay, so we got a little bit before you're even considering that as well. Still need a little.
I'd like to get a little bit more excited. Yeah, I'd like to see that market get a little bit more excited on the upside first.
Okay. It stalled out a little bit last night, but that's not a big deal. Just wasn't sure if maybe that caught your attention yet, because we did bring it up, and want to stay on the forefront of that and pick your brain, because things have changed a little bit. The dynamics have changed a little bit since we last talked on Friday. So,
I would say so if we get back to there's an intraday high. So you got a big leg down on the break down on the 18th of June in the Shanghai index. That's the big leg down where there's this sort of big gap between levels, and that's where the descending triangle really kind of broke through. The first bounce off of that, one thing I like to do is you look at the first intraday bounce following the most directional leg of the most important breakdown. And that first intraday bounce is well underneath that breakdown level, but that forms a high that can be retested on the first excited bounce that you see following it. And oftentimes that's an interesting short opportunity. So that would be maybe another 0.5% to 0.75% higher for China, and that level almost perfectly corresponds with the 50-day moving average, which is declining. So on the daily chart. So I think that one extra little spit up, I probably would look to fade that.
Okay, Brett, if you could put together a chart, because I don't have a Shanghai chart. So if you could do that with how you draw the lines in, like you do in your morning note and whatnot, and maybe we can attach that to the archive of this one, and then when the listeners go back and listen to it, they can see it on the visual of exactly what you're talking about. Because unfortunately, all I have is the A-share chart, and that's not a good representation. It's a good vehicle in which to trade it, but as far as
currency effects and all sorts of stuff.
Yeah, not only that, it's got a bunch of gaps in it because of the moves in the Shanghai. So by the time the New York opens, a lot of the move has already occurred. But if you have that, and then translate that to, this is what it would translate into an A-shares trade, that would be great. I think the listeners would appreciate that if you could do that for us.
Got it.
All right. Well, I think that's a good place to wrap it up, unless you have anything else.
No, I think that's a great place.
All right. Well, we've got a lot on deck, so perhaps we'll keep you on standby, and we'll chit-chat potentially tomorrow or Friday, and maybe if there's any new updates or new trades, we'll bring you on. Sound good?
You got it, Jim.
All right. Thanks a lot, Brett.
All right. Take care.
Thanks.